What more can you say? Jonathan Barrett from Commodity Broking Services is in our Sydney CBD studio for some reaction. Jonathan, your takeout from that, if you will, in other words, everyone on a bandwagon in one direction only. Hello, that should send you a signal that we're in danger territory.
Look, Carson, it is a very interesting move because when we first initially saw the stimulus come out, we thought, okay, that's not as good as we wanted. We wanted a little bit more. We wanted a shot. Then we started to read through the fine print, and because it's more of a long, drawn-out sort of summary up until June 2011, we're starting to think that now the Fed is really starting to endorse their weak dollar policy. And as a result of that, we've seen by default commodities start to go up. Now, I'm concerned whether or not commodities will be able to be passed through the market profitably. And this is what your other commentator just said. It's a concern, and I think I endorse it.
Well, are we talking, if anything, about bubbles then? And are we talking about emerging economies putting their hands up finally and saying, this was all just a house of cards. Sorry, chaps, sorry about your growth belief, but bugger it.
Well, I think you've got to take it in definitely two cases. You've got to look at what the West is certainly doing. Now, they're continuing to push more money into the system. Now, it was a system that is starting to show some signs. So we're going to hang on to the unemployment data out on Friday night to see whether we're getting some evidence that the previous policies, the previous stimulus, is actually starting to turn that unemployment data around. So we're going to keep an eye on that. But I think if they're going to continue to put more dollars into the system, it's going to artificially create those commodity prices which are too high.
The thing is, how long do we've seen unemployment at 9.5% for 14 months.
Yeah.
You're telling me that we still don't know whether QE2 has stuck yet or not?
Well, we don't know whether QE1...
That's what I meant. We still don't know after 14 months of pass-through.
That's exactly right. And when you can see that this stimulus, the $1.7 trillion stimulus went through the economy and we're not seeing any signs of growth in employment, it's as if we're giving the US banks are turning around saying, here's the money, but we're not going to give it to the people that need it.
Well, that's an interesting line. Just hold on to that one, because I just want to remind people that US payrolls have now been declining for 4 straight months. 4 straight months. That the numbers haven't just been static, they have been declining. That's just a point made there. Now, your point was, just to pick up on it, that banks are not lending. I want to just put to you that people are not wanting credit. That's a different proposition to one you made, but it's surely one that we need to distinguish and determine which is right.
I think we do. I think we need to work out whether people are starting to spend it, whether the banks are actually lending and people are consuming. Look, when you look at consumption, you've got to look at what the unemployment is actually doing. Yes, it's moving, but that's a lot of money you've thrown up, where unemployment or the official rates are still up around about 9.7. So you're starting to see a gradual process. But I think the concern that we've got, Carson, is that gradual process has been going on for such a long time, and the results aren't as they should have been. And I think that's the worry which we've got, whether QE2 will provide that shot in the arm overnight.
It's very interesting. Ben Bernanke, former Princeton University economist, he studied the Great Depression. He pressed forward with this move, the latest one. That was despite 5 of 18 policy makers going public with objections or doubts. Now, what does that tell you about who the Federal Reserve is really doing this for? Is this to do with the US economy, or is this to do with the markets?
Look, I'm not quite sure on that, because when I see the policy, I look at this form of quantitative easing as a form of experiment, perhaps you could even look at it, but a very dangerous one. And I think that's the concern we've had. You can study the Great Depression and you can see what actually motivates people to actually spend money. And when people spend money, unemployment goes down and economies grow. But we've got the added injection of what's happening in the emerging markets, and that to me is one of the big issues.
What would it take for somebody like Tom Honig, the Kansas City Fed president? 7 times now he's just essentially said the one thing. He said, do not do this, until he was blue in the face. And no one listened. So does he actually have a role inside the Fed? Should he even bother? if
Well,
he's outnumbered persistently?
You have to have a view, and everyone has to vote on that view. I mean, that's the way it works in a democracy. You know, you can be right, but also wrong at the crucial time.
Right.
And it's only going to be a time thing. I mean, we've only just recently commented on what's been happening in China in terms of foodstuffs and food inflation. You know, and these are some of the critical issues. You know, we're trying to combine emerging markets growing at paces with economies which are stagnant.
But is it really a democracy around the Fed, or is that just a fiction? This idea that someone would say, this is going to destabilise the economy. I'm quoting there.
Yeah.
Continued high levels of monetary accommodation. And by that he means $2 trillion with a T.
Yeah.
That's going to destabilise the economy, and no one cares a jot.
Look, I think you've got to view it. Yes, it's important that all issues are put on the table. Perhaps there's more of a need for more of a fiscal and monetary mix over just a monetary policy. And I think in terms of that, the Fed makes the decision, you know, based on what they feel is correct. Remember, they're the ones that are meant to be steering the economy. You know, how much time do you have to give Mr. Bernanke in terms of trying to realise the policies that he's actually put in play? And I think, to me, is it another term? Is it another year?
Yeah.
Is it another 14 months? Who knows?
The thing is, they're trying to create inflation inside commodity markets. They can change the entire trend of these markets and drive away, they say, those deflation demons at any moment. Now, it just seems wholly absurd. It seems totally artificial.
It is. It's a tough one because, and I'll just, if you take a look at the oil market, for instance, you know, we've just broken up on the oil market, and we're probably, if we stay above that $81 a barrel, then there's potential for it to go to 86, even higher. Now, it's not going up there on the back of demand.
No.
It's not going. It's just up there, just hanging around on the back of the US dollar. In fact, it's just playing catch up on a weak dollar policy, and that's all it's doing.
And also, it makes the appearance of the debt that the US is laboured with appear that much less onerous, when in fact it is not.
Absolutely, 100% agree on that. And I think that is one of the things which I think the Fed is actually looking at while it's deciding to endorse their policy of a weaker US dollar.
The problem as well is that these matters don't occur just inside economies anymore. We're in the era of globality. Hot money moves. It knows no borders. Now, essentially, you have a situation now with a Nobel Prize-winning economist who gets about 2 minutes of airtime on another network to say and sound a warning that the deflation in the US will actually potentially leapfrog into Europe. That the euro will spike on this as the dollar gets further decimated.
Correct.
And bang goes any chance of, well, you tell me what happens.
Well, that's the thing, because when you look at it and you bring it down to the grassroots, you know, when you don't have enough money for new investment, then you don't see employment. And if you don't have enough money to buy your primary inputs because they're too high, you slow down. It's the same scenario. We had it in drive time in the US for the demand for crude. People didn't have the money to go on holidays. Oil was too expensive, so they didn't spend.
And never mind all that sovereign credit that is actually washing around the system in the Eurozone. That then becomes that much more expensive to service. That then entrenches their depressed position.
This is one of the big issues I think that we're all looking at, because, you know, are we going to ride on the back of the emerging markets in terms of the supply? And have we seen in the emerging markets already a few signs of concern? I mean, one of the examples we've just seen is in the cotton market. We always felt that China had sufficient supplies of cotton, that they had massive warehouses full of cotton. It's now come to light that they don't. And that's a concern, because cotton, obviously, which is a pretty important primary import, is trading at 140-year highs.
Right. Well, the next big thing was meant to be potash, but sorry, folks, the Canadians have said no to us. Just tell me about this one. This is where rubber hits the road for investors.
It does.
And it's obviously not a laughing matter, but it's often the case, as we know, that when a big acquisition is in the offing, investors can be quite relieved when it doesn't go through in the short term. But what does it mean for BHP's long-term future?
Look, I think BHP's still got another 30 days to contest it. But I think this is a very interesting bid that's gone through, because I think although BHP has the vision to see this market and what it can actually do, the Canadians are now starting to question their sovereign right over their resources. And this is also, I think, seen as a little bit of a political play. So it is a mix, but I think BHP will naturally respond.
It's interesting though, because BHP being a company, Canada being a nation state, a response on that measure, you might well take the old argument, you take on the government and you will always lose. Almost without exception, and that's the caveat. The point would be, is this perhaps an early warning signal of some global inward-looking protectionism? This is the argument with, allied to currencies, curiously, but it's very much playing out.
I think that's an interesting thought, and I think just off the cuff and thinking about it, Australia's had that policy where they've allowed it. If Canada starts to close on its sovereign resources, then it could be a form of closing up a little bit to protect them.
New Zealand is making it quite clear as we speak across the Tasman that every Foreign Investment Review Board application will be, if anything, on first blush and will be presumed to be against the national interest. This is a complete turnaround from their reforms of the 80s and 90s.
It is, it certainly is, and maybe we're going to see a little bit more border protection of this kind developing as the economies start to try and globalise, protecting your assets.
Jonathan, it's been insightful. Listen, value your contribution as always. Appreciate it.
Thanks, Carson.